Good morning to you, and this is Michelle Schneider, Director of Trading Education at MarketGauge, also the owner of the RIA MGAM LLC and partner in a TAMP. So I'm bringing to you today a lot of experience, and if those of you who read my daily, which is available on our website, marketgauge.com, know I've been all over two themes. One is that the market, when I say the market, I mean the overall indices and many of the sectors are in a very stubborn trading range. And number two is that inflation, whether it's cooled or not temporarily over a 7-month decline, it has risen, and all signs look like that inflation is definitely not going away. Even with its decline over 7 months, it's still extremely high, and any of the spark plugs that I have written about over and over could send it to screaming to even a higher high, leaving central banks with a lack of credibility and governments throwing money at their own countries in order to stay afloat and avoid a major recession or a major rebellion as people feel they can't afford to live. So that's the overall macro theme. I have seen no reason to feel any other way. Obviously, a trading range is a trading range until it's broken. But in terms of inflation, obviously that there are people who think that we're going into disinflation. People say deflation. And so very few people are using the word stagflation. So let's take a look here. What you see in front of you right now are the inclines in, excuse me, CPI. Here it says points to persistent inflation, and this is the source of the Bureau of Labor Statistics. And if we take a look right here, just in terms of what we've seen, it rose by what was expected, at least in the overall core. But in terms of the actual year to year, it was 6.4. They were expecting 6.2. And so essentially what we have right now is most of the inflation came out not in goods, that's why people are enthusiastic, but in services, which are sticky. But we're going to take a look at some of the inflation indicators, and I'm going to give you a couple of picks. So there's a couple of areas that you have to watch in terms of what will be the next direction of both the markets, but particularly if we are starting to see any kind of currency debacle, given the fact that BRICS is still an issue here where there are many countries that are looking to price petrodollars in something else other than dollars. And this is a chart of the US dollar. Now, this is based on the end of day cash settlement. The actual price as I'm talking to you is more down here at around 102.90. But more importantly, what you see here is a 50-day moving average and a 200-day moving average. And we are having difficulty with the great rally that people were predicting in the dollar after oversold conditions, really seeing that. So essentially, if the dollar can get through 104, then I think we can probably see a move up to around 106, 107. But if it can't, and this continues, and we break down under this 102.50, then I believe that we will continue to see the decline in dollar. And if we just take a look at a further out time frame here, this is the weekly chart, you can see that your next real line of support would be somewhere between 99 and 100. So the bigger implication is what that would do to the market. Some people say if the dollar is down, that's good for the stock market. Obviously, it would be good for commodities. But there is going to be a point where the dollar down may not necessarily be good for the market because of other more macro factors. And again, like I said, probably the biggest one is what happens to the dollar in terms of using that currency to price goods as important as oil. Now, if we move on to a different chart, let's take a look at the euro through FXE. And the euro, let's go back to a daily chart here. Although trend-wise, you can see that it's doing a lot better. It's above the 50, where I just showed you the dollar was sitting right on the 50. We also had a golden cross here where we're in a death cross in terms of the actual US dollar. This too doesn't necessarily mean that currencies are going to be the place to go. But the fact that it's outperforming tells me that as long as it continues to hold not only the 50-day moving average in our real motion momentum indicator, but also on the price chart, then that means that the euro and the eurozone may not be in the absolute worst shape, or may continue to do a little bit more outperforming in terms of going forward in the US. We have actually one of our holdings is the Vanguard Europe ETF. This is based on our quant model, by the way. So the trend strength indicator here is extremely strong, and you can see that it's just in this period of sideways consolidation. So as far as the inflation picture goes, obviously if inflation spikes, it's going to affect everyone. But for right now, it's interesting to me that the euro is doing better than the dollar, and that we have the Europe ETF, the Vanguard Europe ETF, also doing better than what we're seeing in the indices here in the US. So now let's take that to some of the overall commodities. If we take a look, first of all, at gold. I'm always a believer that when gold dips and looks terrible, that's the time to buy it. And I say that when that changes, of course, that will be when we see the parabolic move. Now, this is the ETF. So in the ETF, we're sitting right here on the 50. Now, I think the 50 is important. Obviously, you can see the gold, which was outperforming this whole time. The SPY is now underperforming the SPY. And if you take a look here at the real motion indicator, though, it's sitting right on support. So everywhere we look, it's sitting on support. But what I find to be most interesting right now on the gold is the weekly chart. Because if this actually continues to hold the 50-week moving average, we can obviously get a buy opportunity if this goes much lower. I'd like to see about 1850 or so hold in the gold futures market. And again, on a weekly basis, it's a little bit underperforming this SPY, not as bad as we've seen on the daily chart. And it's also just broke down under its momentum in a death cross. So like everything else, gold is certainly not really showing a great indication of which way it wants to go next, but it is in a better chart position. So I'd give it a little bit more time. And what's also really interesting to me right here is the silver chart, because the silver too is also sitting here right on the weekly moving averages. The 50 and the 200 broke down a little on momentum, obviously also underperforming the SPY a little bit. But right now we're in a situation where it'll be a good indication between the dollar, the gold, and the silver to see whether or not this market, particularly the metals market, can continue to outperform, or are we going to be in for a serious dip everywhere, which would probably mean more of a liquidity issue than anything else. Now, I think it's also good to look at the food, because the numbers that we saw today in CPI excluded food and energy. So let's look at an actual daily chart on this one. This is the DBA Agricultural Fund. And we are also positioned in wheat, coffee, sugar, and they're all doing really, really well. Which is why I think people who are looking at inflation in terms of goods in the United States particularly are looking in the wrong places. This food situation here, these agriculturals are definitely showing signs of not abating. Anything can drive them further, whether it would be supply chain, weather issues, geopolitics, etc. But what they're telling you right now through the DBA is that you really have to keep your eye on the whole agricultural sector, which means that in terms of a pick, you may also want to be looking at some of the country funds outside of Europe that do grow agriculturals, like, for example, Latin America, which is also oil rich. Hasn't really done very much yet, but looks like this thing, if it goes up a little bit further, will take out the 200-day moving average, and also has an interesting golden cross here on the momentum indicators and is trading above. Another one, of course, would be Brazil. Brazil not doing as well, but nonetheless also held the 50. And this is not in a golden cross. You can see the 50 is below the 200, but one more push over the 200 will have what we call a divergence between an inclining momentum and price. So I would wait for this to clear the 50-day moving average for a couple of days, and then it might be an interesting situation to be looking at, like I said, some of these agricultural countries. Now, if we go to another major commodity ETF, it would be DBC. Now, DBC, this is a daily chart, yes. DBC has exposure to metals and also to energy. And you can see, again, another great diversion, because this is still obviously in a death cross on real motion, but clearing the 50-day moving average in the momentum, had a little bit of a mean reversion back here, but hasn't really gone anywhere yet. So I would say I'd give this a little bit more of a look-see too, because as this week goes on, if we can get a couple of closes, and I'd give it a little bit of room, let's say over 2460, then that also mentions the fact that between the agriculturals, the metals, and the energy sector, that it might be time for us to see a move there, which of course not only would put pressure on the Fed, which by the way, the yields are inverted even more and the long bonds are down, but also would say that even with the Fed raising rates, can they really control the issues of inflation that have absolutely nothing to do with their own particular monetary policy unless they get super aggressive? And another one I want to show you here is natural gas. It's something I haven't really watched since I made the spectacular call, by the way, in 2021, where it more than doubled in price. We started buying natural gas back down at around 7. We added at 11, and we watched this actually go all the way up to a double. We haven't traded it really, even this rally. We missed it in 2022 because we thought that it might be cycle time to be over. So what interests me about natural gas right now is that where we've had other periods where it goes down and then quickly ascends and then comes right back, in all of the moves that we've seen lower in this really big move down, which of course had a lot to do with the fact that the winter wasn't nearly as bad in Europe as people feared, this run looks like another type of level of consolidation at a time where it could prove to be a very interesting play. I don't necessarily would want to get into it now, but I figure any kind of move over 9 would mean that you would have a really good risk down to under the low of about 8. So you would have an ability to risk about $1, which is unusual in something like this, to see if this can get at least a move back to test up to the 50-day moving average or around 12.50 to 13. That's a nice risk reward. So all of this, if you put this all together, essentially what you've got is A, CPI that's definitely showing signs of not only service stickiness, but excluding the energy and the food, showing and looking at these charts telling you that it's not necessarily looking at the whole picture. There's still a lot of spark plugs, as I mentioned in the beginning, happening not just with weather issues, but also with a lot of social unrest and of course geopolitics, things in Russia, things in China, things in Israel, things in the even in other areas, Peru, etc. None of that has really abated at this point. And on top of that, you have a lack of credibility in the central banks to really be able to control this type of situation, feeding the public that we are heading into more of a disinflation period and that everything is just cheerful and wonderful. And I hate to give you a negative message on Valentine's Day, but nonetheless, these are the areas that I would be watching for. And of course, finally, the most important is this persistent trading range that we're having here in the SPX. That trip to 4,200 that we can't quite get over. If you go all the way back to here, that was the last time back in August when we had the big rally and we started to decline. The last gasp was at 4,200. And of course, we do have support at 3,900, but if that breaks, I'm still predicting we could potentially see 3,200. Okay, I hope you enjoyed. Thanks so much for watching. Look for me on Twitter at Market Minute and go to marketgauge.com to find my daily content. Bye-bye for now.